Hi, and welcome to Macro Wednesday. When we talk macro, try to make sense of markets that, how can they make sense? And more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and I have got a lot on my mind that I want to share with you today. I want to look at some data. I got questions. We got everything. And isn't this the most crazy speculative rally in stocks maybe ever? Look, I was alive during the tech bubble. It was pretty crazy. This is beyond explanation. When I look at the market today, and I think about, okay, why do people buy stocks? Well, they buy it for future earnings. Do people actually believe the market's going to be going up so much over the next 10 years that for some reason, over the last couple months, they have missed out? It kind of baffles me of what they're up to. You know what it reminds me? It reminds me of a kid on a hot summer day. He's laying around the house and he hears the ice cream truck going down the street. And he thinks, that's a great idea. Pops up, finds some change, and goes running down the street. And then there's that moment about, 20 seconds later, he realized he'd left his shoes on at home. And he's burning his feet. But he keeps going because he's got to get the ice cream. Got to take my money. I don't get what people are so worried about missing out on. So are we going to have inflation? Is that it? Is it, okay, finally we're going to have inflation and stocks are going to go up. And I need to get my money in there because inflation is going to shoot them up higher. No, the data is not showing that at all. Oh, it's got to be QE. Is this QE thing? Man, it makes stocks go up. Yes. Oh, that's got to be it. QE makes stocks go up. And yet no one who is in the QE makes stocks goes up camp can explain to me how they went down between February and March of this year. Because we were doing QE then. Why did they go down? It shouldn't have gone down. That violates the rules of QE raises stock prices. I don't get it. But investors, and they are playing chase. And when you really think about it, and what's cool about this show is I challenge you to think, and I show you how the data works. So I want you to think about it. Don't email me right away on this. But remember, stock markets go up on selling. Think about that for a while. And if you're having trouble with that, put yourself virtually in your mind, visualize yourself at an auction. Think about it. Run through some scenarios. Prices rise on selling. So why are we seeing in the markets? Why is there this desperate chase to get interest rates higher? Because remember, if stocks are going to rise, what do we need to go with them? We need interest rates to go up. And what are they really doing? They're more like, well, probably this direction looks better for you. They're kind of like this. Stocks don't hold those gains unless interest rates go up. And so what's happening is investors, it's like a board on the ground, and they're bending this board, like, going to get yields to go up, yields to go up, yields to go up. And they're fighting this thing so hard, and yields are barely moving. I mean, they've moved a little bit, but when you look at all the short interest in the futures market and all the other speculative positions and people are selling bonds, I mean, they're literally just bending this board as hard as they can because they need interest rates to go up. But there's a component to that I think people are missing. It's not just they need yields to go up to support stock prices. That's important for them. But what's the major narrative right now? What causes stock prices to mythically go up? Quantitative easing. So how do you get the Fed to do more QE so you can be comfortable at night knowing that the speculation that you are taking in stocks from companies who've decided to pull their forward guidance in their earnings, meanwhile the whole economy around the world is in shambles, that you can justify your risk? Well, it's got to be the QE. So how does the market get the Fed to do QE? They literally take these yields and they try to force them up because you cannot have an economic recovery if interest rates go up. I mean, think about it. Why do interest rates go down for 40 years? We say, well, what about before that? You mean when we went off the gold standard? You know, between 1966 and 1982, stock prices didn't go anywhere. They didn't go anywhere. And then 82, they start going up. We need lower interest rates to fuel an economic recovery. It's how a debt-based economy works. Do you think millions of Americans are going to go out and buy cars? So, man, I'm glad the interest rates on cars were 5% because, at zero, I just thought that was unfair. Oh, man, I really thought the banks were going to go out of business giving me a loan at 3%. I'm just really happy to have a 7% mortgage. No, not how it works. Because what people need and what the financial system needs is home prices or interest rates should go down so people can cash the equity out of their home, pay off their high interest debt, and go spend some money. That's what we need. That's how it always works. You cannot get an economic recovery with higher interest rates. If we were to have higher interest rates during a recession, it would just prolong the recovery for years. And so the market's saying, hey, we're going to make the Fed do something they don't want to do. Because right now, the bulls are saying, we got this. If we can just get the Fed to do more QE, boom. And the Fed's got to be looking at this going like, man, do I want to come out there and appear to be supporting stock prices? No, because the reality is the Fed needs yields to go down. They know it. The market knows it. And it's like one of those, it's like a dare. Come on, Fed. Come on, ease with stock prices going back up. Ease, we dare you. And if you won't do it, we'll force you. We will do everything in our power to drive interest rates higher. What will the Fed do? Well, in my mind, there's no doubt they were going to have to do more quantitative easing. Now, I don't know when, if it will be next week or the week after. They'll have no choice. And quantitative easing itself does not just lower interest rates. It's an interest rate suppressor. So let's say that yields are generally headed down and they're starting to push up a little bit. This is what QE does. It goes, pushes a little pressure on it. That's all it does. It's just kind of like, hey, I'm going to push down. That's all it does. If you want interest rates to go up, then tell the federal government to start borrowing less money. Tell them to pay down the debt. Because all this debt issuance is going to cause interest rates to go lower. All QE does is just put pressure on it to stay lower. And the wild thing to me is the market's so desperate. Give us the QE. They're like addicts. QE, I'm taking so much risk. I need QE so I can sleep at night to know that my stocks won't ever go down. But what does QE do? Causes interest rates and stock prices to go down because it's deflationary. It's deflationary. So bring on the QE. So I think the Fed will have no choice but to increase their purchases. I don't know if it'll be next week or the week after. I think they'll have no choice. Now today, something unusual happened, and that is the Fed was purchasing 20 to 30-year Treasury bonds today. And the market, they didn't actually complete their full order. The banks didn't want to sell to them. So they only did 70% of the offer. Banks didn't want to sell. Now, why would that be? You have to sometimes ask, why would that be? Well, if I'm a bank, and I'm a large commercial bank, and I'm making money on this deal, I want to buy all the 30-year Treasury bonds I can up here so I can sell them back to the Fed somewhere down here. Now, the way the banks make money on this is very simple. The banks use their own reserves. This is very important. Their own reserves that they built, and they will take those reserves and they will go to the primary dealer, which effectively they own, and buy Treasury bonds. And the Fed will come in with QE, buy those bonds at a premium. Now, it may not be a huge markup, but at a premium. And they will take that money and deposit it in accounts at Federal Reserve banks at the bank where the commercial banks can't touch. So what happens is in QE, the banks just get a little bit more reserve. They go from the reserves they can touch to reserves they can't. That's the process. So the banks do get something out of it. But I bet you they're loving the market where it's at right now. I bet you they're buying up all the stuff they can get. And it makes sense when we think about like the Fed's going to have to come back in the market a little bit bigger. There's no doubt they probably want to. The question is, when will they? Because what choice do they have? Well, look at the bank side. When we saw this in a video maybe a couple weeks ago on a Friday video, I said, what can the banks do with their bonds? They can hold on them, collect interest. They can sell, loan them to speculators who short them, or they can use them for a loan, as an asset to back a loan. When the Fed comes in, it takes all those away. And all the banks get is the interest off of that reserve account. And so what happens is lending standards tighten. And is there any surprise that today Wells Fargo announced that they are going to stop issuing car loans to small independent dealerships? That's not normal. Maybe because lending conditions are tightening. And if the Fed comes back into the market with a heavier hand, all those people that are speculating on the bonds, all the Fed's doing is taking them out of circulation. So as the Fed comes in and eventually keeps gobbling them up, they squeeze out all of these short sellers and they trigger the biggest short squeeze ever. That's what the market doesn't get. Everyone's like, oh, interest rates are going to go higher. Look, the Fed is going to beat you. They're right now on track to buy on an annualized basis somewhere around $2.2 trillion worth of debt. If they don't ever increase it, they're going to pull the supply off the shelves. They are going to eventually squeeze people out. It's just a matter of time. And so that comes to a question about what's going on in the corporate and high yield bond market. Well, the Fed appears to be printing money. People say they're buying junk bonds so people can sell their junk bonds and buy stocks, and that's why the stock's going up. Really? Really? Because last I saw, people were buying junk bonds because the Fed was buying them. So how is that translating to money flowing into stocks? Well, someone's got to sell, Steve. Sure, and someone's buying too. Do you know why the Fed is really doing this? I mean, the real reason they're doing it? Because the moment banks started pulling all of their credit lines, or what's called revolvers, not a gun, but think of what you have on your, if you have a home equity line, think of the banks have an equity line, but it's unsecured. They're called revolvers. And courtesy of Jeff Snyder of Alhambra Partners, who has correctly surmised that the reason banks are pulling their revolvers at a rapid pace is because they figured out all these quote-unquote liquidity injections by the Fed are nothing. They learned that in the great financial crisis. So they've gone out and they pulled all this short-term money. Now the Fed knows that some of these companies are going to issue shares to pay that back, so they're going to issue new stock shares. Most of the companies are going to issue new debt to repay it. And guess what the investment grade bond market can't handle? All that money flowing into it. And so the Fed realizes that if all this money flows into, or all these new bonds flow into the investment grade bond market, what's going to happen to corporate interest rates? Not Treasury, keyword, corporate yields. Boom, they're going up. And guess what the Fed doesn't want? Hey, we can't have interest rates going up on this corporate debt. That'd be bad news. So they're coming in and buying corporate debt to take some pressure off of the investment grade bond market. So why are they buying junk bonds? Well, because the Fed also knows that some of these investment grade bonds are going to turn into junk. And they are also fully aware that the junk bond market can't digest that either. So they're just taking some pressure off the markets. It's not creating any money to flow into the equity markets. It's doing it so those who like to buy junk bonds and like to buy investment grade bonds can still do it without the market forces causing yields to skyrocket as bond prices between junk bonds and corporate bonds tank. That's what's really going on. So it looks like money printing is kind of sort of ish, but remember, these are loans. The Fed is loaning money into the special purpose vehicle, or what I like to call the trash can. Special purpose vehicle that will have to be paid back at some point. I do not know when. I do not know the terms, but I do know at some point the money gets paid back. Now I want to take some time and I want to look at the economic data, because I want to educate you on how to be a better macro analyst yourself. So how can you look at the data and understand? And let's share with you some of the things that I look at. So let's go back to Tuesday. And one thing that I really have interest in is the Red Book weekly retail sales. The market never hardly even looks at this, but on a month-over-month basis. So this is last week from the month before. Now remember, we saw stores reopening since last month, so one might assume that month-over-month sales would start to show some sign of improvement. Last month they were down 1.5%. This month previous week 1.5%. This week 1.4% down. And on a year-over-year basis, this is going from last week. The year before, we're down 7.2% from the week before of minus 5.5. So what is that telling us from a macro perspective? This pent-up demand to go out and shop is not showing up here. Now, it doesn't mean it won't in the weeks to come, but at the moment, it's not showing up. It's telling us that consumers are not spending as much as the government really hopes that they will. Let's continue and look at some of this other data. One of the most confusing things are these PMIs. So if we look at Japan Services PMI, Purchasing Managers Index, so these are people that work at services companies reporting on a survey. And last month, in April, it just crashed. I mean, this is a massive contraction in the services sector. Now, here's what most people will read this. They'll go, oh, 21.5, it went to 26.5. So that means it got better. No, this means there was another fairly large crash in the services sector after last month. So April, big crash. May, not quite as big of a crash, but pretty big. And so it's telling you the service sector in Japan is in bad shape. Now, if we go into today, we can look, and let's just skip to the Eurozone. So we got the market composite PMI that says, look at the service. This is the services and the manufacturing sectors composite. Last month in the Eurozone, it was a bloodbath. Now you go, wow, 13.6 to 31.9, things got better in Europe. No, they contracted again. Just not as bad. And at 31, that's a pretty decent contraction on top of a monster contraction. And look at the services sector. Same thing. Was literally just slammed to the ground and then contracted again this month. And what's interesting, then you get to the PPI data. This is called the Producer Price Index. So the way you understand the PPI index is if you are a manufacturer, your producer prices is what you're paying coming in one door. Consumer prices are what you're selling them coming out the other door. So the way you know what consumer prices are going to do, if you see rising producer prices, guess what they're going to do? They're going to pass it on to consumers. And if you see falling producer prices, guess what they tend to do? Pass that on to consumers. Look at this. On a month-over-month basis, we went from 1.5% last month to minus 2%, or minus 1.5% to minus 2% in April out of the entire Eurozone. And on a year-over-year basis, this is deflation. Minus 2.8% last month, now minus 4.5%. This is deflation. And this is telling you that between the services index and the PPI, things in the Eurozone are bad. And anyone here, I know we have some friends that are watching the show from Europe, they know, they're probably nodding their head. Yeah, things here aren't good. Let's go on. I tend to look at the mortgage data, and you can quickly see that applications are down 3.5%. The market is excited. The purchase applications are rising, even the refinance. But here's what we don't know in this data. We do not know if these are people that are, say, retired, recently retired, and maybe have put an offer in on a new home or moving out of their state, and they're signed a mortgage application and they haven't sold their old home. We don't know what the deal is here. But let's go on to the U.S. data. We see the market composite PMI, and let's take a look at this a little bit. Let's look at the services one. They're about the same. So we see pretty large contraction in April, and then not so bad of a contraction in May. So you see contraction, a second contraction. So if you open this up, the way you can read this is 50 means, excuse me, no change from the month before. So back in March, we go to our late March, Actually, I'm reading this wrong. But anyways, we go to this one here. I think it's April 3rd. Is that right? Yep, April 3rd, and we see a contraction. This is the first contraction. Then the next month it contracted again. Now, you say, well, look, the bars are the same. No, it contracted a second time. Then it really contracted a bunch, and then it took another monster contraction, and now it's only contracting at a slower rate. It's still a pretty big contraction in the services sector. That is not good. And we go to the more official ISM, non-manufacturing PMI. Let's take a look at it. It paints a little bit different picture than the market report. And market, not M-A-R-K-E-T, M-A-R-K-I-T. And you can see that going back in, let's see, April or March, what we have here is a slight expansion in the services sector, a contraction in the services sector the next month, and then now we're seeing a smaller contraction. So according to ISM, there are 2 months of contraction. So this is very important to know that the services sector is not rebounding. Now let's talk about crude oil, as the market is solely fixated on what's going on in the crude oil market. And I think there's something here, and I do have people that watch this that work in the industry or retired in the industry, and if I'm wrong, then don't worry. Within minutes of them watching, they'll send me a message and tell me I was wrong. But there's this focuses on crude oil inventories. Oh, they're down 2 million barrels. How great is that? Look, the forecast was up 3. But look at distillate stocks, rose 9.9 million barrels. How about gasoline inventories? Up to almost 2.8 million barrels. And people are not looking at the distillate stocks and what's going on there. And this has been rising for weeks now. And let me show you what's going on there. So I went to the EIA website, which is the official government report of this. And my hunch has been that the reason we're seeing refiners run distillates, which is a lot, think of jet fuel, diesel fuel, stuff like that, is because there's storage there. Now, I'm not an expert in storage at all of distillates. I don't know anything about it. What I do know is I can look at a chart and say, hey, we're running around 175,000 barrels in storage. There was about 170 here when it peaked, around 175 here, and back to the earliest data in 82, it got up to 182,000 barrels. What is that telling me? The refiners are sticking distillates in storage because that's what's available, and it's almost full. It's almost full. How about gasoline? It looks a little bit better. But let's go take a look at gasoline inventories. Now, this data goes back a little farther. But what I predict will happen is once distillates are full, then the refiners will run whatever they can fill next. And it's not, oh, there it goes. And you can see, look, gasoline inventories are fairly, they're really high. So what's going on in the markets to me, and again, I'm not the foremost expert on oil, but what's telling me in the oil market is that they're trying to fill everything they can with anything they can. And now let me share with you, and I think this chart is a little bit wrong. I think the number is much higher, but this is a global floating storage from Bloomberg and ASEAN Research. And you can see they're running around, 50 million barrels sitting at sea. This is something that's not tracked in that EIA data at all. And now they're saying it's up here somewhere around 80. I think the real number is close to a couple 100 million barrels. But if this is the case, 80 million barrels sitting at sea is a lot. It's a huge, huge amount. So people are very bullish on oil. And it doesn't make any sense to me. Because I think we're a matter of weeks from finding out that there's nowhere to put distillates anymore, nowhere to put gasoline anymore, and there's not enough demand. And lo and behold, would it be a surprise that not too long ago, I think it was last week or the week before, that Chevron announces a 10 to 15% cut in their global workforce? Do you think they know? And wait till everyone else jumps on the bandwagon. Don't worry, they will all follow suit like soldiers. You'll watch all the majors cut, and then you're going to watch all the smaller producers cut because they know. Now, I've got some questions, and these are a little out. I like to take them in order, but these questions are right in line with what I was talking about, or with the junk bond market. So I want to answer these. We'll pick up some charts, and I'm planning on doing a Q&A video this weekend, and that way I can have some time to answer the questions that needed a little bit more time. But let's take a look at these real quick. Since the Fed owns J&K, LQD, etc., this is junk bonds and corporates, which include bonds from companies like Hertz, which went bankrupt. What happens to these bonds when the companies go bankrupt? Well, they go down in value. Do the banks unlock the cash from the reserves in that way or any such case? No. Will that be printing money then? No. Thanks for the show. Woot! No. So what happens here is it still stays in the old trash can, and it becomes worth not a whole lot. Now, we don't know if there's rules in the trash can that say if it goes to zero that it has to be, removed from the can. I don't know, because I'm sure the Fed's not expecting that to happen. But anyways, it goes in the trash can, and then it's not until it comes out of the trash can that the U.S. Treasury makes the Fed whole. So us as American taxpayers, we have to make the Fed whole because the Fed can't lose money on these transactions. As far as we know at the moment, no, it does not unlock any reserves, not to my knowledge. Hi, Steve. Thanks for the videos. Recent subscriber, and I learned a lot already. Awesome. Well, thanks for joining us today. I watched your video about QE's deflation, and I have a question relating to that video. You mentioned that video the Fed can't print money. That is correct. However, in the latest round of QE, they are already actively purchasing ETFs such as J&K and LQD. Aren't these direct purchases of ETFs as well as corporate bonds from existing holders of these securities who could be retail investors essentially putting the money into their brokerage accounts? Yeah, it could be. But again, this is where I mentioned earlier that I think the issue is they're trying to take the pressure off of the corporate and junk bond market. I don't think there's enough individual investors that matter in this space to do that. Therefore, it seems like they're indeed printing money. Maybe I missed something in the logic here, so I would appreciate your thoughts. Have a great day and stay safe. I will. I appreciate that. Like I said, it looks really close to printing money. I mean, if you wanted to go and say this is in the gray area, this is it. However, there is a point that is someday those things come out of that trash can, and that's when the money printing would end. But I do believe this is solely to take pressure off of the bond market because it couldn't digest it. Thanks for answering my question on your video. I also wanted to ask that since stocks follow yields usually, do you think the Fed's intervention to buy corporate bonds and high yield ETFs through the BlackRock has distorted the credit market and encouraged investors into the equity market? Actually, I think it's more encouraged investors to buy into the bond market, into the junk bond market. Assuming the Fed continues with these purchasing, what would cause equities to go down with bond yields so low? Well, anything. I mean, it could be buyer exhaustion. I mean, there isn't an infinite amount of money to buy stocks. At some point, there will be more sellers than buyers. The economy is deflating. So, we'll find out at some point that earnings are miles apart from stock prices. But there are people that sell high and will probably sell in this market high. So no, markets aren't going to go up forever no matter what the Fed tries to do. So let's take a quick look at some charts, because as we look at the equity market, we see gaps all over the place in the S&P 500. And I'm kind of starting to believe this may be the blow off top here, where I expect the stock prices to start to head lower. We'll see if that reverses. But you remember, these gaps will eventually get filled, which suggests that stock prices are going to revisit this low down here. Maybe it'll be the big double bottom. I don't know. But that is still to come. And same with the bond market. You can't see there is a gap here, but this thing is gapped up all the way up to here. And again, the Fed is going to be under pressure to, even if it's just psychological, to do some more quantitative easing. Simply for nothing else, you can't have recovery with higher yields. And if the Fed comes back, or if they just outrun the speculators, which they can do, there's no question the Fed has the time and tools to do it, they will squeeze those bond shorts. And when they do, they will force to become buyers of bonds, have to sell their stocks. And that's another way you can get falling stock prices and falling treasury yields. But remember, that relationship can be distorted for a period of time. You can get higher stock prices and relatively lowish yields, but at some point, one of these changes direction. And right now, the bond market may be bending, but it's not breaking. I'm Steve Van Metre. Thanks for watching, and I will look forward to seeing you on Friday, and then this weekend, where we will have even more questions of yours to answer, and I'm looking forward to it. Thanks for watching. Bye now. The content of this video is provided as education information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I'm going to do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.